Chapter 1, Investment. People have broadly two options to utilize their saving. They can either keep it with them until their consumption requirements exceed their income, or they can pass on their saving to those whose requirements exceed their income with the condition of returning it back with some increment. Saving versus investment. Saving is just the difference between money earned and money spent. Investment is the current commitment of saving with an expectation of receiving a higher amount of committed saving. Investment involves some specific time period. It is the process of making the saving work to generate returns. Investment versus speculation. Investment and speculation activities are so intermingled that it is very difficult to distinguish and separate them. An attempt can be made to distinguish between a speculation and investment on the basis of criteria like investment time horizon and the process of decision making. Investment objectivity can be defined as investors' goal expressed in terms of risk, return, and liquidity preference. Some investors may have the tendency to express their goals solely on the basis of return. The return objective may be simplified as follows: capital preservation. It means minimizing or avoiding the chances of erosion in the principal amount of investment highly risk averse investors pursue this investment goal, as his investment objective requires no or minimal risk taking. Also, when funds are required for immediate short term, investor may state for capital preservation as the investment objective. Capital appreciation. It is an appropriate investment objective for those who want their portfolio value to grow over a period of time and are prepared to take risks. This may be an appropriate investment objective for long term investors. Current income. It is an investment objective pursued when investor wants a portfolio to generate income at a regular interval by way of dividend, interest, rental income, rather than appreciation in the value of portfolio. This investment objective is to mostly pursued by people who are retired and want their portfolios to generate income to meet their living expenses. Estimating the required rate of return. Investment is the commitment of rupee for a period of time to earn a pure time value of money for investor postpone their current consumption. Compensation for expected inflation during the period of investment for the change in the general price level. Risk premium for the uncertainty of future payments. The price paid for the exchange between current and future consumption is the pure rate of interest. It is the rate of return the investor demands even if there is no inflation and no uncertainty associated with the future payments. Required rate of return is the minimum rate of return investors expect when making investment decisions. It is to be noted that required rate of return is not guaranteed return or assured return. It is also different from expected or forecasted return. It is also different from realized return. Real risk-free rate is the basic rate of return or interest rate assuming no inflation and no uncertainty about future cash flows. It is compensation paid for postponing the consumption. The nominal risk-free rate of return is the rate of return an investor is certain of receiving on the due date. Investor is certain of the amount as well as the timing of the return. Types of risk. Business risk is the uncertainty of income flows caused by the nature of firm's business. Financial risk relates to the means of the financial asset, debt or equity. It is uncertainty caused by the use of debt financing. Liquidity is defined as the ease of converting an asset into cash or at close to its economic worth. The more difficult the conversion, the more is liquidity risk. Exchange rate risk is the risk uncertainty of return introduced by the acquiring investment denominated in a currency different from that of the investor. Political risk is the uncertainty of returns caused by the possibility of major change in the political or economic environment in a country. Geopolitics is influence of geography and politics on economic and relationship between countries. Geopolitical risk is the risk associated with wars, terrorist act, and tension between states that affect the normal and peaceful course of international relations. Regulatory risk is the risk associated with uncertainty about the regulatory framework pertaining to investment. Relationship between risk and return. Types of investment. Equity. Equity share represents ownership in a company that entitles its holder a share in profits and the right to vote on the company's affairs. Equity shareholders are residual owners of a firm's profit after other contractual claims on the firms are satisfied and have the ultimate control over how the firm is operated. Equity shareholders are residual claim holders. Investment in equity shares reward investor in two ways: dividend and capital appreciation. Fixed income. Debt instrument, also called fixed income instrument, are contracts containing a promise to pay a stream of cash flows during the term of the contract to the investor. The debt contract can be transferable. A future is specified in the contract that permits its sale to another investor, or non-transferable, which prohibited sale to another party. Government versus corporate debt securities. A government security GSEC is a tradable instrument issued by the central government or the state government. It acknowledges the government's debt obligations. Such securities are short-term or long-term. Corporate fixed income securities pay higher interest rates than the government securities due to default risk. The difference between the yield on a government security and the corporate security for the same maturity is called credit spread. High yield versus investment grade. Higher rating denotes lower default risk and vice versa. The convention in the market is to classify bonds with rating BBB and above is investment grade, and bonds below the BBB is high yield or junk bonds. Many institutional investors are prohibited from investing in junk bonds as they involve high default risk. Money market versus capital market. Money market securities have maturities of 1 year or less than 1 year. Treasury bill, commercial paper, certificates of deposits up to 1 year maturity are preferred as money market instrument. Capital market is a place for long-term fund mobilization. Securities with maturity greater than 1 year are preferred to as capital market securities. Stock and bonds are capital market securities. Commodities. Commodities are subject to higher business cycle risk as their prices are determined by the demand and supply of the end products in which they are consumed. Soft commodities historical have shown low correlation to stock and bonds, hence they provided benefits of risk diversification when held in portfolio along with the stock and bond. Real estate. Real estate is the largest assets class in the world. It has been a significant driver of economic growth. It offers significant diversification opportunities. It has been historically viewed as good inflation hedged. Investor can invest into real estate with capital appreciation as investment objectives as well as to generate regular income by way of rents. It is usually a long-term investment. Real estate is a classification classified into two subclasses: commercial real estate or residential real estate. A structured product. Structured products are customized and sophisticated investment. They provide investor risk adjusted exposure to traditional investment or to assets that are otherwise difficult to obtain. A structured product a greatly used derivative to create a desired risk exposure. Many structured products are designed to provide risk adjusted returns that are linked to equity market indices, sector indices, basket of stocks with some particular theme, currencies, interest rates, commodity, or a basket of commodities. Distressed securities. Distressed securities are the securities of the companies that are in financial distress or near bankruptcy. Investor can make investment in the equity and debt securities of publicly traded companies. These may be available at a huge discount. However, investment in them requires higher skill and greater experience in business valuation than regular securities. Channels for making investments. Investor can invest in any of the investment opportunities discussed above directly or through intermediaries providing various managed portfolio solutions. Direct investment. Direct investment are when investors buy the securities issued by the companies and government bodies, and commodities are like gold, silver. Investor can buy gold, silver directly from the seller or dealer. In case of financial securities, a few fee-based financial intermediaries and investor buy or sell investment with broker, depository, advisor, etc. or for fee or commission. Registered investment advisor. So investor can take the advice from SEBI registered investment advisor. These advisors are paid fees by the investor who hires them for investment advice. These advisors, like other fee-based professionals, are only accountable to their investors. They are required to follow a strict code of conduct and offer advice in the investor best interest. Thus, advisor can help investor to create an optimum investment portfolio and help them in making rational investment decisions. Investment through managed portfolios. These investment vehicles are professionally managed. Through these managed portfolio, they can avail the professional expertise at much lower cost. The following are example of the managed portfolios solution available to investor in India: mutual fund, alternative investment fund, portfolio management, collective investment skills. Mutual fund. A mutual fund is a trust that pools the saving of the number of investors who share a common financial goal. Money collected through mutual fund is then invested in various investment opportunities such as shares, debentures, and other securities. The following are benefits of the investing through a mutual fund: professional investment management, risk reduction through diversification, convenience, unit holder account administration and services, reduction in transaction costs, regulatory protection, product variety. Alternative investment fund. Alternative investment fund or AIF is privately pooled investment vehicle which collects funds from sophisticated investors for investing it in accordance with a defined investment policy for the benefit of its investors. These private investors are institutions and high net worth individuals who understand the nuances of higher risk taking and complex investment arrangements. The minimum investment value in AIF is 1 crore, 1 crore. AIF are categorized into three categories. Category 1: AIF is an AIF that invests in a startup or early stage ventures or social venture or SMEs or infrastructure or other sectors. Category 2 AIF is an AIF that does not fall in category 1 and 3 and which does not undertake leverage or borrowing other than to meet day-to-day operational requirements or as permitted in the regulations. Category 3 is an AIF that which employs diverse or complex trading strategy and may employ leverage including through investment in listed or unlisted derivatives. Portfolio management services. A portfolio manager is a body corporate who advise or clients or directs or undertake on a behalf of the investors the management or administration of a portfolio or securities. There are two types of portfolio management services available: the discretionary portfolio manager individually and independently manages the fund of each investor, whereas the discretionary portfolio manager manages the fund in accordance with the direction of the investor. The portfolio manager is required to accept minimum 50 lakhs or securities having a minimum worth of 50 lakhs from the client while opening the account for the purpose of rendering portfolio management services to the client.